Okay, classwork contemplation. Let's talk about taxes and eventually developing a little bit of a financial plan, which we've been talking about anyway, around those taxes, how to be smart with them. How income tax works. Would you rather you and your family keep more of the money you earn? Would you rather give it to the government? Most of you have probably had jobs and you noticed that when you get your paycheck, it does not equal the amount that you thought you were going to make. I remember learning that lesson when I was a kid. The very first job I had, I was about 12 years old. My best friend and I, there were greenhouses across the street from my home. And my best friend and I covered the chrysanthemums that they grew or the mums that they grew in the greenhouse, because they could only get a certain amount of light every single day. So we would carry these big, heavy canvas, black canvas tarps down the rows and cover the plants. And we were promised something like $2 a day. So that would work out to be $14 a week. But we would only get like $11 in change or $12 or something. And I remember the guy who owned the plants was Mr. Klaus. And I went up and I said, Mr. Klaus, you said $2 a day. And that's when he explained to me what FICA was. That's when he explained to me what Medicare was and income taxes and everything else, and how it all had to be taken out of my paycheck. And I'm like, what the heck? I can't believe this is happening. So you do not make as much as you think you make, and large chunks of it are taken out. And that's why people get concerned when taxes go up, because when taxes go up, paychecks go down, and people don't want their paychecks to go down. It is generally difficult enough to afford this world on a full paycheck, let alone less of a paycheck. Income tax preparation flow chart. So we're going to go through this and show you basically how your income tax is paid and what you can do along the way to make it better. Okay, so first, what is your gross income? Your gross income is the total amount of money you make in a given time period, like 2 weeks or whatever. So this is the first box up here in the upper left, gross income. Now we have to figure out some adjustments to income. Now listen, first off, I'll make you a promise. I am not going to test you on the technical definition of adjustments to income and so on. I simply don't know enough about it. I know math. I do not know accounting. But the gist of what I'm about to tell you is true. And the whole point is to get you to manage your money better. It's not if you know the difference between an adjustment and a deduction and taxable income and adjusted gross income. I'm never going to test you on that sort of stuff. But I do want you to get a feel for how taxes work. So it's important that we consider these things. So I could be slightly off on my definitions of which things are which, but the general idea behind this, that I'm accurate about, because I pay these things every year. Okay. Adjustments, taxes paid. Taxes have to be imposed by a government. It could be local, state, federal. You then get to deduct them. Like for instance, the big thing when Trump was president, they did this, what they call SALT tax, state and local taxes, and they capped it at $10,000. You couldn't deduct more than 10 grand. So to some extent, you're able to take off taxes from your income and deduct that much from your income. So for just argument's sake, if you made $100,000 and you paid $10,000 in taxes, you would adjust your income to $90,000. You wouldn't get taxed on money that you never got because it was paid to taxes. Does that make sense? Okay. Other things like the interest on your mortgage payment is deductible. Okay. There are many ways to get deductions and adjustments taken off on your taxes, and that is why you do not listen to me about what they are. You go to an accountant and you let your accountant do the work. Now, one of the good things that, I'm not getting into whether Trump was good or bad, you can have that argument all day long, but one of the really good things for younger people like yourself that Trump did was he simplified the tax return form, where he said everybody could take off what is just a general deduction, and the deduction's pretty high. So you got two ways. You can, like, as a teacher, you can deduct certain things, like you can deduct traveling to union meetings. You can deduct, if you coach, certain attire just for that purpose. I used to run the photography club in school, and every single year I bought myself a nice lens or two, and I could deduct the cost of those lenses from my salary. So there are ways to take them off. Now, those are things that you tend to deduct when you're a little bit older. You tend not to have those deductions when you're, say, 20 years old. But when you file your income taxes, if you made, say $10,000, a significant amount of money, you can claim the standard deduction. And the standard deduction was probably more than you would have had if you tried to itemize the deductions. So there are ways to get your income less, and they are called deductions. And there's also some exemptions that you have. Deductions and exemptions are amounts subtracted from the adjusted gross income before calculating your taxes, and they vary from person to person. Like I said, I could take off camera lenses. I have a buddy who loves photography, and he has nothing to do with teaching a photography club, so he has no legal justification for deducting the cost of lenses. So if he buys a lens, he's not getting a tax break. I buy a lens, I get a tax break. Well, back then, not anymore. Exemptions are fixed amounts of money per person. So for instance, when our children were younger than 18, I think, 21 maybe, whatever the number, we get credit for each child that we were raising. And then as they got older, we didn't get credit for that anymore. Oddly enough, I believe if you have like an older person, like your great-grandparents, and you have them come back in and live with you, I think you can get a deduction for that too. But again, talk to an accountant. That's why they call it a dependent and not a child. There are many deductions, but but items like dependents and charitable contributions qualify. So that is, look, I don't give away charitable money because I want the tax deduction, but I'm certainly going to take advantage of it. So we pay a particular amount every single month. The very first thing I pay every month when it comes in is the mortgage. The second thing I do is I try to take care of me. To be honest with you, I haven't always had the money to pay myself first, but lately I did in the past. But most of the time I pay myself first. I put some money in the bank. And then I pay charities. Those are the first three things I do. Then I pay my household bills. Then I look at how much money I have left over to go play. You can take off the charitable deductions. When I go see my accountant, he'll say, how much did you spend? I say, I spend this much money a month, and then we take that much money off of our income taxes. But again, that's why you go to an accountant. You let him do that stuff for you. Okay, so we've adjusted our income. And now we get to the point where we have a taxable income. And the taxable income is the amount of money you could not deduct from your gross income. So you've taken off your taxes, you've taken off all the things that you're allowed to take off, your deductions, everything else. And now you're going to figure what is your taxable income. Well, right before you do that, you need to figure that there's one little other thing that you could do. Okay? You could get tax credits. And sometimes there are amounts authorized by Congress that can be deducted from your total tax bill. For example, $1,000 tax credit for each child. That's really cool because that means you don't have to pay the $1,000. You're not just getting the deduction of $1,000. Deductions reduce your income, your taxable income. Like for instance, more or less around, my deductions typically ran around 10% for charitable giving years ago. So at one point probably around, whatever. It's not now because I don't make as much, but back then it was probably around $15,000 a year. And then, but I only got the tax credit on that $15,000. I don't get the full $15,000 back. I get what taxes I paid on that $15,000 back, which at that time were probably around $3,500. So I would get $3,500 back out of the 15 grand spent. If you get a tax credit, if you spend $1,000, you get $1,000 back. Okay, so big difference between a credit and a deduction. All right, so we're working our way down the plan. The total tax is, there's a table made up by the federal government that, or the state, because states have tables too. For not every state, like a state like Tennessee doesn't charge a personal income tax. There's, I think, 4 states that don't. And New York has one of the highest. I live in New York, so I know all about that. And Jersey has a pretty high one too. The state tells you what you owe based on your adjusted income. So you whittle your income down. You start with, this is how much I made in gross. And then you take all the legal deductions you can possibly take, and that gets you to a significantly lower number, particularly if you own a house, because you get to take off a lot of things with a house. No, again, forced to get a house instead of renting when you can. There's many financial advantages to having a house. And then you only pay taxes on the part that remains. Okay? So let's just say that according to the table, you should have paid $5,000 in taxes, and you only had $4,000 taken out of your check, then you owe the government $1,000. On the other hand, and that's $4,000 withheld from your check. Let's say that withheld from your check was $7,000 and you should have only paid $5,000, then you get $2,000 back from the federal government. Okay, so we're in this last column now. So let's talk about a couple of examples, or let's talk about Marnie. Marnie earns wages of $28,400 and she receives $95 in interest from a savings account. And she was entitled to a personal exemption of $3,300 and a standard deduction of $5,150. Find her gross income, her adjusted gross income, and her taxable income. Okay, so her gross income is all of the income put together. So that would be $28,400 plus the $95 she got in interest. So that's $28,495. That's pretty easy. Now, the adjusted gross, this is where, look, I'm not going to test you on this, but just to give you an idea, the adjusted gross, you're going to take off the personal exemption from that gross income, and that gives you $25,195. And then the taxable income, you also get to take off the standard deduction of $5,150. So when you take that all off, you get down to $20,045. So she only owes taxes on the $20,045. She doesn't owe taxes on the whole $28,495. Now, it's important you understand something else. When your employer withholds taxes from you, they do it based on the gross, not based on the taxable income. So for most people like me and you, unless we try to have the government withhold less, which I don't think you should do, then at the end of the year, in April 15th, tax day, when you file your taxes on or before then, you usually get a check back from the government because they had too much money of yours. Now, you have a certain filing status. You can file single, you can file unmarried, you can file divorced, or you can file legally separated. Those are all the different types of single. You can file married, filing jointly, which is what my wife and I do, married filing separately. I never really understood that one, but it is an option. Or the head of household, which is unmarried and paying more than the half of the cost of a supporting child or parent. Again, I've never done that, so I don't know. I know you can choose that option. I don't know much about it. And then they give you these tables, okay? So what they're saying is, like, let's look at my wife and I married filing jointly. If we make up to $16,700 in a year, this is your taxable income. This is not your gross, okay? The tax rate is 10%. And then up to $67,900, the tax rate is 15%. Now, I just want to clarify something. If you are in this second tax bracket, which is what they would call it, up to $67,900, and it's 15%, what you have to understand is that the first $16,700 is still taxed at 10%. That's true for everybody. I don't care if you're a super gajillionaire. The first $16,700 is taxed at 10%. The next money up to $67,900 is taxed at 15%. And this, by the way, is from 2009. It's not the current tax brackets. If you make up to $137,050, the first $67,900 is 15%, and then everything from $67,900 to $137,500, which is $137,550, which is around $70,000. It's just less than 70. That would be 25%, and then it goes up to 28, 33, and 35, and so on. Okay. The standard deduction, if you're a single, is $5,700, and it makes sense that the standard deduction from married filing jointly would be $11,400 because you have 11. That's two people. 57 times 2 is 11,400. So that's where they come from there. All right. Each higher marginal rate begins where the previous one left off. That's what I explained to you just before. All right.